One of the biggest mistakes that people make in retirement isn't how they invest, it's when and where their money gets taxed. And once you retire, your ability to change that starts to disappear. That's why, as America's IRA expert Ed Slott says, the real goal is moving assets from forever taxed to never taxed. And in this video, we're talking about how to maximize the Roth, the most powerful tool in the tax code for creating tax-free retirement income. If you've been following this series on building a 100% tax-free retirement income, this is where the strategy really comes together. Most people think of a Roth as just another type of retirement account, but that mindset is exactly why so many people underuse it. The Roth isn't a product, it's a strategy. Roth IRAs, Roth 401ks, and Roth conversions are simply different tools that all serve the same purpose, allowing you to decide when taxes are paid instead of letting the IRS decide for you later on. Whenever someone asks me whether they should do a Roth, my answer is always the same. Compared to what and for which phase of your life? Roth money plays by a completely different set of rules than any other dollars that you own. When structured correctly, Roth assets grow tax-free, they come out tax-free, and they don't increase the taxation of your Social Security benefits. They also don't put you into higher Medicare premium brackets. And if those dollars are held in a Roth IRA, they're not subject to required minimum distributions. That flexibility becomes incredibly valuable later in retirement, often at the exact moment people realize they don't have enough of it. Now, let me slow this down with something that I see constantly in real-world planning. Many clients come in believing the same thing. Once I retire, my taxes will drop. And sometimes that does happen, but often it does not. I've worked with retirees who replace their paycheck with a combination of Social Security, pensions, and portfolio income. Then required minimum distributions begin. Investment income stacks up on top, and suddenly they realize they're in the same tax bracket they were while they were working. And in a number of cases, they're in a higher tax bracket. This catches people off guard because the plan was always to deal with taxes later. Roth money gives you a way to deal with taxes before they deal with you. Even though current law extended today's tax brackets beyond 2025, those rates are still historically low by long-term standards. Congress has also added temporary relief along the way, including a senior deduction that can provide up to $6,000 per person after reaching age 65 if your income isn't too high. But the key word there is temporary. These provisions have expiration dates, and waiting for the perfect future tax bracket often means missing the years when you have the most control over your income. The biggest mistake isn't paying tax today. The biggest mistake is assuming taxes will be lower at the exact moment that you have the least ability to change them. This is why I often frame the Roth like this. It's not a bet on tax rates. It's insurance against uncertainty. I'm sure you've heard not to put all of your eggs in one basket. Basically, diversify your investment risk. The same thing applies here. Don't bet your entire retirement with the delay and pray strategy. Congress can change brackets. They can change deductions. They can change income thresholds. What they can't do is retroactively tax Roth withdrawals that were structured correctly. Roth money gives you a tax-free option no matter what the rules look like 10, 20, or even 30 years from now. Roth strategies are not just for young investors. In fact, some of the people who benefit the most include high earners who are still working, early retirees in lower income gap years, and people delaying Social Security, as well as people retiring to high income tax states like California, New York, New Jersey, Maryland, or Massachusetts, and anyone who wants to leave money to heirs in a tax efficient way. This isn't about today's tax bracket. It's about controlling your lifetime tax bill. Now, there are three Roth mistakes that I see over and over and over again. The first is waiting for a lower tax bracket that never comes. The second is ignoring Roth 401ks because of outdated income myths. And the third is assuming Roth planning is only for younger savers. Each of these delays flexibility, and flexibility is what matters most in retirement. Now, let me pause and summarize what actually matters here. Roth strategies give you tax-free income. They help protect your Social Security benefits from taxation, and they help manage healthcare costs. They also reduce your dependence on future tax policy. This isn't about guessing the market, it's about designing control into your retirement income plan. The Roth is more valuable than ever before. Contribution limits are higher. Roth 401ks are widely available now, and the window to lock in tax-free income is still open. But depending on your age, time to plan may be running out. Used strategically, Roth accounts can give you confidence no matter what Congress does next. This is part 4 of my series on creating a 100% tax-free retirement income. In the next video, we'll talk about how to optimize Roth conversions, one of the most powerful ways to move assets from forever taxed to never taxed. But we will also explain who should not pursue a Roth conversion. You want to make sure you check that out. And look, many of us don't want to navigate financial planning on our own. If you own a business, head over to celestialwm.com and check out my resource center. On it, you'll find 3 case studies of typical clients I work with, and learn more about my financial planning process by watching my 35-minute complimentary training. Make sure you watch this video next for even more ways to supercharge your net worth.